What impact on your capital gains tax calculation does principal private residence relief have? Let's check out the calculation today. Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. As property investors, we obviously don't like selling property. However, sometimes it gets to that point with a property where we need to be selling it. And this kind of tends to happen with properties that we've possibly lived in. So when you've lived in a property, there's something called principal private residence relief. And check out the video on that if you're not sure what that's all about. But it's a great relief, and it's one way of making the capital gains tax bill reduce quite significantly. So today we're going to dive into a calculation and have a look at how it actually works in practice. So let's jump into the calculation and see how the principal private residence relief fits in with our capital gains tax calculation.
So let's start our example with Annabelle, who bought her house, which we can see on screen, for $150,000. Now, she's now gone and sold her house for $250,000, which means she's made a gain of $100,000 on her property before we've done any adjustments. She'll probably have racked up some costs when she sold the property, such as things like solicitors' fees, estate agents' fees, and advertising. And she'll also have paid some fees when she originally bought the house, for example, survey fees, stamp duty, land tax, and more solicitors' fees. So on that basis, we're going to include some estimates of $2,500 in our example today for each of those. It should also be noted that Annabelle lived in this property for part of her ownership period. And during that period, she did some works on the property, so she spent $10,000 on doing those works while she owned the property. Now, the period that she actually owned this property is from April 2008 until July 2023 when she sold it. So for that whole period is when she actually owned the property. She's also let the property, so we've kind of got this mix where she's got a period where she can get principal private residence relief, and she's got a period where she can't. So to reiterate our numbers, we've got our April 2008 through to July 2023, which is when she owned the property, and we've got a period where she let it for. So the ownership period's 183 months, and the period that she lived in this property was when she bought it up until February 2019. Which this is a grand total of 131 months, which that will come into play in a moment when we start looking at our calculation. Now, there is the final last 9 months of ownership that is an allowable period. So for anyone who does have potentially a period where they may have two properties or something else, we have that last 9 months as allowable for selling the property. So in terms of calculating this principal private residence relief available, what we need to do is take the period that is allowable for PPR and allowable for relief, which is our 131 plus 9 months, divide it by our 183 for the total months we've owned, and take it to 76.5% of our net gain that we can deduct as not taxable. Some things to note are, it may be that rather than months, we go down to days. So this is a round and about sort of calculation today. So when we're doing exact calculations, we do need dates of when things were actually purchased, dates of when things were sold to get down to the exact figures. Now, let us move on to our actual calculation. So as you may have seen on the video to do with just calculating your normal capital gains tax, we start in very much the same sort of way, and we take our sales proceeds, which were the $250,000. we take the purchase price and take this off of 150,000. So we also now take off our selling costs, and we're going to take off our purchase costs as well. We very briefly went over the fact that we had some improvements. So on this one, again, we had some improvements. Let's say the garden was done or it needed a new roof. We couldn't claim that during the period we rented it out, but now we're selling the property, we can claim that against our rental, our capital gains calculation. So our net gain before any reliefs are applied is £85,000. And this is where we now need to think about our principal private residence relief. And now we're going to take that 76.5% gain. We're going to multiply it by our 85,000, which gives us a sum total of 65,025. We can now move this down into our calculation. So we're now doing 85,000, take away our 65,025 to give us an actual taxable gain of £19,975. Now, the net gain is then deducted from the 6,000 tax year allowance, which is the 2023-24 tax year allowance. So that gives us an actual gain that we're going to pay tax on, £13,975, which will be taxed at the appropriate rate depending on how much your tax rate is of either 18 or 28% based on your individual tax position. There are some options where you may be able to transfer the property into your spouse's name before it's sold, which then means you get 2 lots of personal allowance, so taking it from 6,000 to 12,000. This is one way of reducing the tax that you may have to pay.
As you can see, the principal private residence relief has had quite an impact on the calculation and has really brought that capital gains tax amount down. So hopefully you can see for any properties where you have lived in, there is some benefit to making sure that you're claiming your principal private residence relief to help reduce that tax bill, which is obviously the aim of the game. Hopefully today you've discovered how it reduces your capital gains tax if you've lived in a property. If you've got any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing.